Welcome to A Dose of Alpha. Today we got a little bit of a spicier one. Eric, how are you doing, sir?
I'm doing great.
The greatest sign of intelligence is how far in the future you can predict an outcome. We're risk curating now the first AI prediction market.
There are more that are trying to solve resolution problems with AI. I think that drastically undersells what profits, creating profits, solving the cold start problem, where you can create markets with opinionated perspectives. Where, like right now in poly markets, like you can create a market and hope and seed liquidity and hope somebody else gambles in your market, but you can't show up with an opinion and make a bet because there's no liquidity to pull from. And so basically having a house casino to go to where you could just show up and place a bet on a market that never exists, and the first player shows up and provides liquidity, and that's us, that's the house.
Eric, this has been a crazy week of prediction markets. I think we've gone deep into massive amounts of alpha. You were just going to tell me a story. I was like, okay, we got to get this on the podcast about prediction markets. Let's set the context. Let's set the floor. There's a battle going on, a philosophical battle that I feel, and maybe you feel as well, that is prediction markets versus perps, and when to use which one and when to play one. And we started into it. And is that the right set of context, the framing for the setup of the story?
Kind of, yeah. Prediction markets, how market makers are doing with prediction markets, toxic flow, just in general what the future of trading of and for information looks like, really.
Okay, so full disclosure, we invested in an AI prediction market. And one of the ideas that we came up with a prediction market was that if we had a spot oracle of some nascent asset, I'm not going to dox what the nascent asset, but like think like weird, low liquidity type of objects that people find valuable, but may not historically like have valuable, like a la NFTs, but not NFTs, but it could be NFTs, but it's not. But something like that, you could effectively create a futures market with a prediction market with an NFT. And you came back and said, well, actually, it would be better with perps. And so I wanted to dive in. You have a story. I'm gonna toss it over to you for this.
Yeah, so prediction markets go back to, like, I consider them options. They are options, so with expiration, and perps are more, they make more sense than options. So if you're going to do a prediction market, it tells me that you have certain price targets. But if you have perps, then anyone can have their own price targets, and they can change at all times in real time. Prediction markets seem pigeonholed. If, say, said potential NFT, like NFT type thing, are you going to say, is this going to go from $3 to $5? Like, great, it goes to $11 in 4 days, and now the market's dead. Nobody's trading on it. It's already just about closed out. Whereas in perps, now there's a lot more people shorting. You're getting squeezes. There's constant action. There's constantly something to do. Or you're having to split up new markets. You're having to siphon out and having like liquidity sectioning issues that become difficult on prediction markets. So prediction markets are the newest, coolest thing. I don't think they replace perps. I think both two types of protocols will exist. One is the super options, and one is the ultimate, like, better than options, which is the what perps are.
Okay, you think perps are better than options, but it requires volatility, right? It requires volatility and constant oracle prices.
It requires interest. I think there's a lot of things with open interests, or the most open interests probably have the least volatility.
Like T-bills? Like borrowing against T-bills, or?
That might not be enough. It's a great question. If there's enough of a funding rate. So where I could see it working with T-bills is like things in Forex, where it's like borrowing one currency against the other. If there's demand to borrow one asset against the other, that creates leverage. That leverage creates what would translate to like high utilization in a money market. Wherever there's high utilization in a money market, that translates to funding rate in perps, which brings it in more open interest. So if you get open interest on both sides, then you don't need the volatility. And with less volatility, it's actually easier to get higher leverage to make it to wherever makes sense.
I met somebody at the DAS New York conference, and they basically said to me, the reason why options are built the way that they're built is because nights and weekends, and we didn't have the technology before, and perps is a more beautiful primitive because it's 24/7, and it just prints and it just goes, and it's just tech on all the time.
If you build it from scratch, it's always perps. It went to options, so not only because nights and weekends there's some kind of gap that they can't experience, but also tax reasons, how and when to mark something to market. It's all about the regulatory compliance, not about like what actually makes sense just from the market's perspective in its own beautiful self.
From the capital efficiency and technical efficiency, perps, the reason why we have the ending durations is so markets can close, you can taxable event. Interesting, bro. They're like the rollover strategies. Like that's why if you get like super complicated in these like options rollover strategies and borrowing against an asset to be able to do the option strategy, sometimes it's even the asset itself, which is an options overlay strategy, which is what a company I used to be at called Stratify. Sliced investing got purchased, turned into Stratify, which was an options overlay strategy. It's all coming full circle, Eric.
All of that like janky closed type stuff, like you see it in prediction markets now, you see it in Pendle as they get to their expirations. Anything that has this type of options expiration date, when it starts and when it stops, it gets really ugly. And then you have to create all these janky products around making it less ugly. And when you get to the end goal, the limit approaches zero of all this shenaniganery, it's just perps. There's just no expiration. So why not start with that? Because it's just easier.
Well, obviously prediction markets have like other niches that are not necessarily, I mean, like if it's a singular event, so if it's a continuous price discovery, it seems like perps may be a better fit, but like event driven of like a political election or something like that, obviously you wouldn't do a perp on that.
Very limited asset classes work for perps. Perps fundamentally are basically like a really efficient, UX-friendly, clean version of a money market plus a DEX, where you just get to, borrow somebody from something, do a loop strategy. Like these are literally loops. You are literally borrowing money from somebody to do these. It's just one quick container.
They're so expensive in comparison to money market loops. Like, dude, there are like gaping holes of like interest rate arbitrage. Anyways, going back to, wanted to hear you started on a story before this call, before this stream. It was about card counting. You have like a little bit of a notorious background. It's a light notorious. You're, the good guy. And so I want to hear the story.
So yeah, some context is we are investors and contributors to an AI related prediction market platform. And we're doing a lot of like what it takes to be a house, to be a generalized passive liquidity provider so that people can take opinionated perspectives. And the risks in doing this is that the house can lose. And casinos, the house can lose. And my background in card counting is I would actively beat the house. But there's more than just winning and losing a single hand of blackjack when you can monetize things like data and distribution channels and still make a whole bunch of money when you operate every year at a loss, like something like Uber. And so my thoughts on this is data itself is valuable. If we operate as a house, we lose money as a house to retail. Figuring out how we're losing, figuring out how these attacks are taking place and adjusting our models gives us the best data on how this is taking place. In card counting, I joined Discord in like 2015, 2016 because I was in some like advantage player Discords and we're comparing notes on different casinos, their house rules, who's got like the highest EV as a player. And there was like the story about this one casino back, I think in the early 2000s, that just offered the best rules, like $5 minimum, resplit your aces, double down after split, offering surrender, just like really, really high penetration in the deck, like 85% pen. Card counting terms that matter to like what your end goal is going to be. And so everybody flocked there and everybody made money on them. They had kind of low maximums, so they're not winning like hundreds of thousands, but a lot of people winning thousands. And they let this go on for 2 or 3 months. They just ate the losses, didn't ban everyone. It was too good to be true. And then they banned everybody in one fell swoop and started the black book that they sold and shared with all of the other casinos. This was a giant like fishing net to bring in all the card counters because it's too good to be true. Get them all in one place, get them all doxxed, and now they're all permanently banned everywhere.
Bro, that's what I call smart beta.
Yes, they took a calculated loss. Yes, they lost money. Yes, the gamblers did win, but it made the house so much smarter that in the long run, it saved them so much money. And the data itself was monetizable because by them spinning up that book, they actually charged access to the other casinos. And they were like a nobody casino that became somebody and got a really good reputation internally. By doing this, like we went to ETH Denver. I spent all my time with prediction markets because I'm obsessing over this kind of stuff. Lots of conversations with market makers. Everyone's trying to adapt these new primitives. Everybody's struggling to find out what's a real flow through volume when you're dealing with insider trading, how to handle toxic flow and not lose money as professional market makers. You want to understand the toxic flow, get it in one place, see what works, offer up losses and learn from it, get machine learning. This kind of data, this kind of potential house loss will teach you how to be a better house.
It's almost like the liquidity incentive structure of like sushi now is a Venus flytrap of toxic flow of LP providers that you could mark and map that are probably like mercenary that will come and lose. Like everybody that was on the stable launch and plasma launch of those wallets, those funds, if you could track those funds, you could track those wallets where they come, this is mercenary capital. You could start to be able to tag the wallets of mercenary capital versus in your terms, toxic flow or mercenary capital versus good flow. And this is really interesting. I talked to, hopefully I'm not doxing this, a couple of years ago, I talked to Uniswap. I'm sure it's okay to talk about. The biggest thing that they were trying to figure out was how do you get more retail flow versus toxic flow? Then just instead of just like arbitraging LPs, how do you get retail investors to come trade on Uniswap as a first line of sight versus like a centralized exchange or other DEXs? That was like the challenge that they were looking at, is like, okay, do we do a chain? Do we have to do like a new primitive? And I think they went the app store route, right? So I think they kind of like went that direction to like trade to the user. Like this is like direct interface to people. Super interesting. So this is why on the first iteration, there's going to be kind of like a 50,000. We'll post this later on, a $50,000, $100,000 kind of like trading incentive at the beginning. The thesis here is, hey, we need to understand the toxic gamified markets that potentially the house avoids.
It's my job to design to risk curate for this, infinite house, which has infinite attack vectors, which people are rightfully flagging like, hey, this isn't safe. Like, no, I mean, being a casino itself isn't safe, and this is next generation. But what better way to get information than to actually like have structured payments to lose? Like, hey, we're willing to lose so much money over so much time to make sure it doesn't happen again with bigger budgets, with bigger risks. Come be the first card counters, come give us the information, and come collect these bounties, because the first to win, like, it is going to be beatable. And if we do this structured enough, if we learn enough, then if it's not doable, then now we'll know, but we'll only risk budgets that we are willing to lose. If it is doable, this is how we get there. Because I can red team till you're blue in the face. I'm very good at it, but
yes, you are.
There's always more. So we've got categories, we've got expected losses, we've got expected attack types. We're doing our own simulations, we're doing our own ways to break it, and we're learning from all of these attacks we're able to pull off. But we can only pull off so many. And as we have machine learning, as we have loss prevention agents, so got to build our own little LP force, which is pretty fun. They will learn and we'll pick and choose which bets we're willing to accept, which bets we're not, at what levels, to make sure that we're giving people games that are fair, and we can keep providing the games because we're in business.
Fair enough. Like sometimes look, we don't want to like screw anybody over, but we want to be able to play the game in a way where we can continue to keep playing the game and not have somebody come in one fell swoop and just like swipe away or like hack an AI. I mean, like the attack vectors on this thing is like pretty massive set of attack vectors, like AI coordination, prompt injection. There's like oracles. I mean, everything that you have like in a money market before, it's like smart contract risk. Now it's like the oracle. The AI is the oracle. The AI is the market resolution. There's a lot of like fun games that we can play in there. And now, like with the advancement of these models, like month after month, like how we choose the models that come in to like play the game, that's like a whole nother like meta level of competition of oracles, of AIs. Cause like effectively like how they predict the future on these potential outcomes of these markets and how good they are at it. My wife, Tatiana Colligan, brilliant woman, she came up with this quote: the greatest sign of intelligence is how far in the future you can predict an outcome. So how many potential realities and how many different variations and simulations you can predict and how far out into the future you can predict that is the sign of intelligence. And so what we're kind of starting to see here in a philosophical point of view is how far these AIs can accurately predict and simulate results into the future. And the further out into the future they more accurately predict results, the more intelligent it would be, that each AI would be.
That's interesting. I like that quote.
I got chills. So we're risk curating now the first AI prediction market and writing the tokenomics for it.
The first single player prediction market.
Single player prediction market.
There are more that are trying to solve resolution problems with AI. I think that drastically undersells what profits, creating profits, solving the cold start problem, where you can create markets with opinionated perspectives. Where like right now in poly markets, like you can create a market and hope and seed liquidity and hope somebody else gambles in your market, but you can't show up with an opinion and make a bet because there's no liquidity to pull from. And so basically having a house casino to go to where you could just show up and place a bet on a market that never exists, and the first player shows up and provides liquidity, and that's us, that's the house. And the house has to have plus EV and offer bets that, it knows are, equitable enough. It's going to offer bets that nobody else is offering, but it needs to have enough EV to not go broke. And that's where this crazy, crazy unforeseen type of risk curation comes in. We just saw Chaos Labs leave Aave, and part of it citing like how different redemptions and liquidations for RWAs work in Aave v4. This is so many more levels than that in level of risk. And we're not pretending it's going to be fully safe. We're not pretending that it's guaranteed going to win, but we do believe it's going to get there. And this is the only way to solve it. We're the only ones doing it.
It's lovely, dude. That's so much fun. It's going to be gnarly. And maybe one way not to make a light bulb. And there's 1,000 ways not to make a light bulb. There's one way to make a light bulb. And if we don't do it, and if it breaks, then we get smarter on what not to do, and everybody gets smarter, because this primitive is not going away. Perps, if you go back to the core thesis, like price speculation, store of value, interest rate arbitrage, rate discovery. And perps are definitely rate discovery. Prediction markets are definitely part of the rate discovery, but we have another weird little niche within prediction markets that is beyond rate discovery. I don't even know what to call it yet, but it's some form of like computational future projection of utilizing AIs to its most financialization. Like if you have an AI that's smarter than our AIs, then you should be able to win every single time. My AI is smarter than your AI, Eric. Like it's weird, bro.
What is money where its mouth is? Show up.
That's right.
Show its profit. If it does, if you do beat me, if you do take my money, then I'm going to learn from that and you won't be smarter than me anymore. Or you may be smarter than me, but you just don't have any games to play.
Ooh. So you want to win, but you don't want to win in a way where you destroy and where you don't want to play together anymore.
There you go. You want there to be a house for you to beat, which means that the house needs to beat enough people, enough to sustain your payout. So it's a complicated game, but I mean, this is the same thing that market makers are having to deal with right now with toxic flow. We're going to find out so many things about bets that we're no longer willing to take. We're going to refuse service to so many advantage players until we're at a point where it's like now enough of our business is throughput, healthy traffic. This data now for market makers shows you like, hey, these are the bets where you can get real volume that's not extractive, that's not insider. And here are the bets where you can't. Which is probably even more important for them, what to lay off of, where they are going to lose money. Then we're fine taking a lot. We want people to come and to play and to win. We just want it to be balanced. Casinos take entire months at a loss, but in general, Vegas isn't crumbling. The casinos were built because enough people play the game. There's enough of both sides of every pool that the house gets theirs. And so we want to be a place where people continue to play. We want to be a place where people continue to win, but we want it to be balanced so that there's always a house to play games at.
From your perspective, I completely agree. Like it is a game, it is a gambling framework. There is another perspective here of that game and gambling framework starts to create this wisdom of crowds layer at enough scale that starts to give more information to society on different particular acts, right? So it becomes like this really strange, like libertarian ethos is like, should the knowledge be available? Should insider trading even be a thing? It is in America. And then you start to really get into this weird scenario of like whether or not like the future will allow on a global basis. Can you even stop insider trading? The amount of things that you're going to have to play whack-a-mole across the board here is just insane because there's going to be infinite games to regulate.
It's a great question. The idea of insider trading being illegal is to stop insiders from profiting off information that is itself valuable. But if it is valuable, it becomes a commodity. And so there is no scenario in which insider trading doesn't happen. It's just, is it public or not? I would love to, if Milton Friedman was still here, hear his exact thoughts on prediction markets, because he talks a lot in his writing about the sale of information and how price itself is the fastest indicator of information like possible. It is the ultimate oracle. It's how all business, all society functions, and that any regulation and imposing upon that just reduces inefficiency and destroys a free market. So it seems like the ultimate scenario. However, this ultimate scenario also gets rid of market makers because the people with information are constantly making money because they're selling information to the public at the expense of the liquidity providers, which makes it scary to be a house, but also beautiful at the same time as long as you're able to monetize that data. It's scary. I think it is a fact like that insider trading does exist and that it has. And so at this point, it's how do we choose to move forward with that and not? I kind of like wallets and accounts are being banned on Polymarket, and that people are actively tracking people that we think are insiders, because now information in the information age is flowing so much faster and so much more accurately than just having quick distribution because money's behind it.
It reminds me of the idea of dataism. Have you ever heard this one?
No.
That data wants to be free and float around and coagulate and aggregate and distill with other data. And so anything from like a chaos theory nature that's releasing more data into existence is probably the most likely scenario, because we're going to be releasing more data and more data and more data. And there's this fundamental thesis of like, that is the progress of humanity, society, or in the whole entire philosophical religion is called Dataism. It's very strange, but it sounds like the more data we capture and the more that we release and the more that we consume, then we're on the path of a Dataism path.
A wise man once told me that you can pursue 2 out of 3 things, being truth, happiness, or money. And the pursuit of truth, my interpretation of what you describe as dataism, the more data that you have, the more truth you understand or at least have access to. And the restriction of data is definitively holding back the truth. Yeah, I like you from a libertarian perspective, agree and think that we're going to continue progressing towards free dataism. From a Christian perspective, it's like, hey, at the end, all secrets will be made known public,
Yeah.
Was it Ashley Madison or whatever? We'll get doxxed and like you'll find things out. The Epstein files will come out and people will find out what's going on. So your secrets are only secret for so long because everyone's watching you somewhere.
That's right. And this right here has been a dose of alpha. Eric, thank you so much for your time.
Thank you, Bryan.
It was awesome.